A historic slump in global demand for premium alcohol has left the world's biggest drink makers sitting on what industry insiders are now calling a lake of unsold spirits, forcing companies to shut distilleries, pause production and slash prices to move bottles piling up in warehouses. From Scotch whisky and American whiskey to Cognac and Tequila, the slowdown has hit almost every major category of aging spirits. According to financial disclosures, 5 of the world's largest listed alcohol producers, Diageo, Pernod Ricard, Campari Group, Brown-Forman and Rémy Cointreau, are collectively holding close to $22 billion worth of maturing spirits. This is the highest inventory level in more than a decade. In some cases, the scale of the problem is extraordinary. At Rémy alone, maturing cognac inventory is now valued at 1.8 billion euros, almost double the company's annual revenues and close to its entire market capitalization. Analysts warn that these stockpiles are intensifying debt pressure and could eventually trigger a price war in the global spirits market. Industry analysts say the current inventory buildup is unprecedented. Bernstein analyst Trevor Sterling says spirit stockpiles have now surpassed levels seen even after the global financial crisis. The roots of the problem, he says, lies in decisions taken during the pandemic. During the COVID years, lockdown fueled a surge in alcohol consumption. Expecting the boom to last, producers dramatically increased output in 2021 and 2022, aging millions of liters of spirits that are now coming fully online. But soaring inflation brought the industry back down to earth. As disposable incomes tightened globally, consumers cut back on premium alcohol, triggering profit warnings, leadership changes, and a sharp investment pullback from the sector's biggest names. Some analysts believe deeper societal shifts may also be at play. Rising health consciousness, moderation in alcohol consumption, and the growing use of weight loss drugs such as Wegovy and the Ozempic are increasingly being cited as factors reducing demand, particularly in developed markets. For producers of aging spirits, the volatility presents a unique challenge. Unlike fast-moving consumer goods, spirits like whiskey and cognac must be planned years in advance. Cognac makers, for example, must decide today how much cognac will be aged for 2, 4, 10 or even 12 years, long before the demand is clear. Nowhere in the downturn more visible in this market. Export of French cognac plunged 72% year on year in Feb 25, according to the industry body BNIC. The slump has been compounded by geopolitics, with China imposing a 34.9% duty on European cognac amid trade tensions with the European Union. At a recent earnings update, Rémy's chief executive admitted elevated supplies mean prices are likely to fall. During the pandemic, premium cognac sold for as much as $45 a bottle in the United States. Prices that have since dropped closer to $35. The tequila sector tells a similar story. A decade-long boom fueled by celebrity-backed brands linked to Hollywood stars pushed producers to invest heavily in new distilleries. But just as new capacity came online, demand collapsed. By late 24, Mexico was sitting on more than 500 million liters of tequila in inventory, almost equal to its annual production. In the United States of America, the world's largest spirit market, the slowdown is accelerating. Sales of major brands from Don Julio Tequila to Jameson Irish Whiskey continue to slide, with data showing the decline worsening compared to previous months. So far, producers have avoided heavy discounting on the scale seen during earlier crises such as whiskey losh of the 1980s, but the balance sheets are under strain. Debt levels at companies like Diageo and Pernod Ricard have climbed well above historical norms, raising pressures on management to act. As a result, production cuts are underway. Japanese drinks giant Suntory has shut its main Jim Beam Bourbon distillery in Kentucky for at least a year. Diageo has halted whiskey production at facilities in Texas and Tennessee until the summer. But analysts warn this is a risky strategy. Cutting production today could leave companies short of stock 5 or 10 years from now if demand rebounds. As experts note, the boom and bust cycle of the past 5 years was nearly impossible to predict, and forecasting consumer demand years ahead remains a gamble. For now, the global spirit industry is caught between yesterday's optimism and today's slowdown, trying to drain a lake of unsold alcohol while guessing what the world will want to drink next.